Hi everyone, my name is Manda Miguel Kubai, lecturer of New Venture Creation Level 4 with Gert Sibande TVET College, Gert campus. Our today's topic is topic 2, which it is all about financing a new venture. Under topic 2, we are going to concentrate on cash flow statement. Now, what is a cash flow statement? A cash flow statement, it is a statement that shows the inflow and outflow of cash in a business. Why do we have to prepare the cash flow statement? We prepare the cash flow statement so that we know when the business is going to have financial difficulties, the month in which the business will suffer a loss. Now, when we prepare the cash flow statement, we only record cash only. Non-cash items, items that the business, it is not going to receive cash or pay cash. We don't concentrate on them. We ignore them. What type of items are they? We are talking about discount which the business is going to allow when they sell goods to customers. We are talking about the discount that the business is going to receive. Those are non-cash items, as well as the depreciation. Now, let's move and prepare our cash flow statement. Here is the information, the question that we are having. It says, use the following information to draw up an estimated cash flow statement for Lions Security Company for the next 3 months. Use attached answer sheet to answer this question. Then we are told that at the end of March, they had a favorable balance of 5,500. And we are having the estimated income as well as the estimated purchases starting from the month of March, April, May, and June. Other information. They have bought new equipment in March. They paid how much in March? 1,200, which it was a deposit. And the monthly payment are 550 for the next 6 months. The average expenses per month are as follows. Then we have wages, which it is 12,000, telephone, 800, water, 520, rental, 2,200, electricity, 750. Adjustment number 3, or information number 3. It says 25% of all income are on credit. These customers pay after 30 days, meaning that once they sold goods in April, debtors are going to pay 25% in May after 30 days. And then adjustment number 4, it says in May, they will buy a new vehicle to be used to transport staff to their workstation. The deposit is 9,500, and the monthly payment thereafter will be 4,000. Adjustment number 5. An amount of 30,000 was paid into Lions Security Company in April by Abel as part payment for the new vehicle. Now we are going to prepare our cash flow statement. We are going to use this answer sheet. Then our first adjustment, we are told that the business had a favorable balance at the end of March. The previous month bank balance, it becomes the following month bank balance at the beginning of the month. Then we are going to take the 5,500 and it will become our balance at the beginning of the month. Then we are going to record it under the month of April. Then we are having 5,500 as the balance at the beginning of March. And then we move to the second part of our cash flow statement, which it is all about the income. Then cash sales. Every time when the business sells goods, we are going to go back and check our estimated income for April. And that it was how much? April, they are having 13,000 rand as estimated income. Remember adjustment number 3, it was saying that 25% of all income is on credit. And these customers are going to pay after 30 days. Meaning that the 13,000 that we are having as estimated income for March, only 75% of that amount, it is going to be received that month. The 25% of that amount, it is going to be received after 30 days. Then now, let's calculate how much it is going to be the 75% of 13,000. Let's take our calculator and then we punch or type 13,000 multiplied by 75 divided by 100, which it is going to give you 9,750. Sorry about that. 9,750. It is going to be recorded as our cash sales for April. Then let's record the 9,750 as our cash sales. And then moving to credit sales. Our credit sales, it is that stock that we have sold on credit. Now we are told again in adjustment number 3 that after 30 days, they are going to receive how many percent? 25%. Then we sold goods in April. Then we go back to April. Not April, March. Sorry about that. March, estimated income, it is 18,000. Then the 18,000, we're only looking for how many percent? Only 25% of 18,000. Then we take 18,000, we are calculating now. 18,000 multiplied by 25% divided by 100, which it is going to give us 4,500. Then we record the 4,500 as our credit sales for April. Where is it? 4,500 credit sales. Done with that one. And then there was this other transaction wherein the business is going to receive money. Transaction number 5, or additional information number 5. An amount of 30,000 was paid into Lion's Security Company in April by who? By Abel, as part payment of a new vehicle. That 30,000, it is going to form part of our other income. Then we go back to our cash flow statement. Under other income, then we record 30,000 as other income. Then our 30,000, it is there. And then how do we calculate the total income? The total income, we are going to calculate it as follows. Our opening balance plus the cash sales plus the credit sales plus the other income, it is going to give us our total income, which it is how much? It is 49,750. Then we record 49,750 49,750. 49,750 as our total income. Then let's move to expenses. Our expenses, we have estimated expenses for each and every month. Then we go back and check how much it is estimated that the business is going to purchase in the month of April. Then it is how much? It is 3,300. Then we record the 3,300 as it is as our purchases. Then our purchases 3,300. And then we record it as our purchases. Then here we are 3,300 as purchases. And then we move to monthly expenses. Our monthly expenses, we are going to add all the average expenses per month, which is as follows. Wages of 12,000 plus the telephone of 800 plus the water of 520 plus the rental of 2,200 plus electricity of 750, which it is going to give us the total amount of 16,270. And then we go back again to our addendum and record the 16,270 as our monthly expenses. 16,270 as our monthly expenses. Then we go back and check if there is any payment that the business is going to make in the month of April. And then let's go back to additional information number 1. It says that they have bought new equipment in March, wherein they have paid 1,200. The 1,200, it was paid in March as a deposit. And the monthly payments are 550 for the next 6 months. Then we are going to ignore the 1,200 since it was paid in the previous month. We are only going to concentrate on any payment that was made in the month of April. As we are on the other expenses will be those expenses that the business is going to make, which it is not either the monthly expenses or the purchases. And then adjustment number 1 or transaction number 1 or information number 1, it says that the business is going to buy a new equipment in March. They have bought a new equipment in March and paid 1,200. So the 1,200, it was only paid in March. We are not busy or dealing with the month of March. We are only going to take the monthly payment, which it is going to be 550, and that 550, it is going to be paid for the next 6 months. Then our first thing that we need to do, we go back to our addendum and record the 550 for the month of April. But remember, we are told that they are going to pay the 550 for the next 6 months, meaning that again in May we can record our 550, which it is for May, and June as well, 550. Now, I think we are done with our expenses. One thing that we need to do, it is to record the total expenses. And then our total expenses, we are going to add all the expenses, starting with 3,300 plus 16,270 plus the 550. which it is going to give us 20,120. Yes, 20,120. And then in order for us to calculate the balance at the end of the month, we are going to take the total income, which is 49,750, and subtract total expenses, which it is 20,120. It is going to give us our balance at the end of the month, which it is 29,630. 29,620. Then the balance at the end of the month of April, it is going to become the balance at the beginning of May. Then we go to balance at the beginning of May. We said the balance at the end of April, it is going to become the balance at the beginning of May. Then we are going to record the 29,630 as our balance at the beginning of May. 20,630, yes, correct. And then we move to our cash sales. Our cash sales, only remember transaction number 3, it was saying 25% it is on credit. Once they sell goods, 25% it will be credit. Therefore, 75% it is going to be cash. Then let's go back and see how much it is estimated to be received in May. In May, they are estimating that 15,000 it is going to be received. However, 75% of this 15,000 it is cash. Then 25% it is credit. Then let's again calculate the 75% of 15,000. Then 15,000 multiplied by 75 divided by 100. 15,000 multiplied by 75 divided by 100, which it is going to give you 11,250. Then we go back to our addendum and record 11,250 as our cash sales for May. 11,250. 11,250. And then we move to the credit sales. Credit sales, we are told that after 30 days, they are going to receive cash, which it was sold in the previous month. Then we go back to our estimated sales. Estimated sales. For which month? For the previous month. Previous month, it was which one? It was which month? It was in April. April, they estimated that they are going to get 13,000. From that 13,000, 25%, it is going to be received when? In May. Then we go and calculate 25% of 13,000. Then 13,000 multiplied by 25 divided by 100, which it is going to give you 3,250. And then we record the 3,250 as our credit sales. That is the amount that it is going to be received in May from the previous month sales. 3,250. 3,250. Then we don't have other income which it is going to take place in the month of May. And then we ignore that one. And then we move to the total income. Our total income, again, we are going to add the balance at the beginning of the month, which it is 20,630, and we add with 11,250 plus the 3,250, which it is going to give us 44,130. 44,130 as our total income. And then we move to expenses. Purchases, it is the first one. We go back and check how much it is expected. It is estimated as our purchases for the month of May. Our purchases for the month of May, it is 2,200. And then we record the 2,200 as our purchases for the month of May. Purchases for the month of May, 2,200. And then 2,200 for May. Our monthly expenses, as we have done it in the month of April, we have added all the average expenses, which gave us 16,270, which it is still going to be the same in the month of May and June. We can just record that one, 16,270, which it is going to be monthly expenses for May, and again 16,270 monthly expenses for June. And then we go back again and see if there is any payment that the business is going to make in the month of May. Let's look at transaction number 4, or additional information number 4. It reads as follows. In May, they will buy a new vehicle to be used to transport staff to their workstation. The deposit is 9,500, and the monthly payment thereafter will be 4,000. Now, 9,500 it is going to be paid in the month of May. Then we go back to our addendum, other payment or other expenses. May, we have already recorded the 550, and then we are going to add plus 9,500. 9,500. And then we are done with that one. And then moving to the total expenses, we add, starting with the purchases plus monthly expenses plus 550 plus 9,550. We add all the expenses, which it is going to give us 28,000. Let's record 28,520. 28,520. How do we calculate the balance at the beginning of, at the end of the month? We do the same as it was in the month of April. We are going to take the total income for May, which it is 44,130, and subtract the total expenses, which is 28,520. And the balance at the end of the month of May, it is going to give us 15,610. 15,610. Remember, the balance at the end of May, it will become the balance at the beginning of June. We go to June, balance at the end of May, it was 15,610, and it becomes the opening balance in the month of June. Then we are going to have 15,610 as our balance at the beginning of June. And then the second part, which it is the income part, our cash sales again. Remember, 25% it is on credit and 75% it is going to be cash. And we go back to our estimated income for the month of June. We are having 16,500. But from that 16,500, we are only looking for the 75%. Then let's calculate this one. 16,550 multiplied by 75 divided by 100. And that it is going to give us 12,375. And then we record that 12,375. I think now our cash flow statement, you can realize how to prepare it. It is just because of time we're going to finish this one, but it is not difficult. Don't be afraid when you come across a question which requires you to prepare a cash flow statement. It is as simple as ABCD. Remember, we said the cash flow statement, it deals with the inflow of cash and outflow of cash, meaning that you can only prepare the cash flow statement concentrating on the cash that will be flowing inside the business and the cash that will be flowing outside the business. Remember, the trick here, it is for you to understand that in a case where you are given a transaction whereby you will be expected to record, or the business has sold or purchased goods at a credit and cash, you need to calculate that one. Thank you.